Good day everyone, I'm Jimmy, and if you're new to the channel, welcome. If you're not, thank you so much for supporting us all this while. Just remember that every like and subscribe goes a long way in supporting our production. Now, before we dive into today's video, have a look at these disclaimers before we proceed. In today's episode, we shall wrap things up after looking at some of the recommendations of MLP stocks, and specifically Union Gas Group in the SGX that has seen a gradual increase of close to 100% of its market value since the March lows this year. Last week, we ended the episode briefly touching on the upstream and midstream processes of natural gas in which MLPs generally take on the role of the latter. We shall leave evaluating the upstream processes of commodities for future videos, and stay with me as we begin to look into growing interest in downstream processes of natural gas. China has seen an increase in natural gas consumption for the past decade. For many years, China has been plagued by excessive air pollution issues in major industrial cities such as Beijing, Chongqing, Taiyuan, etc. As such, the gradual shift into eco-friendly sources of energy has instituted an initiative to replace coal-fired power generation with natural gas-fired power generation. Currently, according to China's National Bureau of Statistics, natural gas comprises approximately 6% of the country's total energy mix. However, according to China's gas-to-power plan, natural gas market share in the country's total energy mix will increase to 10% by 2020 and to 15% by 2030. So, before we dive into the details, let's analyze how China obtains its sources of natural gas. China has two sources of natural gas. Firstly, its domestic production, in which shale gas is one of its primary sources with huge untapped potential. According to the U.S. Energy Information Administration, mainland China is believed to have the world's largest shale gas resources, as much as 36.8 trillion cubic meters, which is 50% more than in the US. Secondly, it is through imports from pipelines and LNGs. For the existing pipelines, there are two, namely the Central Asia-China Gas Pipeline, where it imports most of its pipeline gas from Central Asia through a three-string A, B, and C system running from Turkmenistan, Uzbekistan, and Kazakhstan to China, and also the Myanmar-China Gas Pipeline. For a proposed pipeline, there are plans for Power of Siberia, which flows from Russia to China, is set to transport 38 billion cubic meter per year for a term of 30 years once operational, after the cost of gas from Russia, previously undisclosed, has turned out to be much lower than expected, and is actually unlikely to be transporting gas anytime soon in this current climate. With reference to China customs statistics, in 2019, China's total natural gas imports were up by 7% from the previous year and has been growing steadily over the past 5 years. Though China's domestic natural gas production has more than doubled over the past decade, production cannot keep pace with demand as population rises and the growing interest in corporations as they become more environmentally aware of the cost benefits of natural gas versus coal or oil in the long run. In the recent few months, though major gas reforms have been implemented swiftly, including the liberalization of market pricing in the downstream sector with the government watching the prices closely, the reorganization of the nation's midstream gas assets under China Oil and Gas National Pipeline Corporation, also known as COGNPC, and the opening up of domestic upstream exploration to private and international companies so as to boost domestic production and reduce over-reliance on imports. China still struggles to produce sufficient domestic natural gas to meet demand growth of such scale. In 2019, based on the National Bureau of Statistics, China is estimated to have produced another record high in terms of annual production volume, 173.6 billion cubic centimeters of natural gas, up 9.8% from 2018, where output had reached a record high. Although the country's gas production growth in 2016, 17, and 18 only registered an annual increase of 2.2, 8.5, and 7.5% respectively, well below the annual growth target of 8.9. The demand for natural gas consumption continues to outgrow their target to meet the 207 billion cubic centimeters production target set for the 13th five-year plan from 2016 to 2020. which seems even more unreachable based on the current gas production projections. The good piece of news is that China's natural gas output would hit 187.5 billion cubic centimeters in 2020, up 8.2% year-on-year, boosted by Beijing's push to increase domestic production. Coupled with the recent news on China's new lows of COVID-19 cases, this further boosts public sentiments and confidence in the authority to deal with the resurgence that swiftly forced 41 out of the 7,000 cities into lockdown after the Xinfangdi market salmon case a while back then. Do you think China has done a tremendous job to control COVID-19 compared to countries like the US? I've attached a few articles below, so do give them a read and leave a comment below. We'll try our best to keep the discussion interactive. After looking at how China's demand for natural gas far outstrips the supply over the years, we now return back to the topic of how China could possibly increase their supply of natural gas. For domestic production, shale drilling in China faces hurdles such as shale formations located in mountainous regions, non-existent upstream infrastructure, higher well drilling costs, where exploration and development costs of shale gas in China were 2 to 3 times those in US, as backed by PetroChina Research Institute of Exploration and Development Studies, limited regulatory support, and scarce water supplies. To back up with some data, according to the Ministry of Natural Resources, the growth of production of shale gas for 2017 and 2018 is hovering around 38% as compared to 2013 to 2016, where it's easily over 100% year-on-year. This further hampers potential private and foreign companies to invest more into exploration and production of shale gas, even though these companies now need not partner with any of the national oil companies starting this year, as plans to encourage investments into the upstream productions of natural gas. As such, despite companies such as ExxonMobil, Shell, and British Petroleum researching and drilling for shale gas, none of their efforts has led to viable commercial production, which has led to an exit from China's natural gas market. In addition to that, much of China's shale reserves and resources, which is around a quarter of China's conventional and unconventional gas reserves, are locked away more than 3,500 meters underground, deep in the Sichuan Basin. It faces the problems of being in a fairly densely populated area, which will be difficult for governments to allocate land and companies to operate under safety regulations set by the government. And in the environmental impact of gas production will have to be taken into consideration as well. All in all, until there's more transparency around the competitive bidding, transfer of exploration rights, and distribution of geological data, coupled with regulations for fair treatment of private and foreign companies, there's likely to be very real competition for the state-owned oil majors in the upstream sector due to great economies of scale they possess. And also, according to the National Gas Development Report by Oxford Energy, providing subsidies for the development of other types of unconventional gas, such as tight gas, could be another way as well. Since production of tight gas, shale gas, and coal-bed methane collectively accounted for 41% of China's total domestic natural gas production in 2018. True enough, in June 2019, the Chinese government introduced a new subsidy program that for the first time offers incentives for domestic production of tight gas from such formations. However, the cons is that only the incremental volume based on previous year's production levels will qualify for subsidies. Do let us know if you think this is a good idea or there are other ways to better incentivize a greater volume of producers instead of incentivizing the pursuit of year-on-year growth that might become unsustainable in the long run for these companies. Fortunately, the good news is that there could still be an increase in the domestic production of natural gas, as both CNPC and Sinopec have stated that they intend to increase natural gas productions following the fall of prices of oil in 2020. Looking at the imports, we are looking at a gradual increase of supply through pipeline gas in Russia and China, as new infrastructure is required for both countries for the power of Siberia. But looking at the current situation, constructions and groundbreaking might have to be delayed. Hopefully, keeping our fingers crossed, it would not take too long. Even after taking into consideration ramping up production of domestically produced and additional supplies of piped natural gas, China will have to increase LNG imports to satisfy surging natural gas demands. According to British Petroleum Statistical Review of World Energy, in 2019, China's demand for imported gas has been steadily increasing over the past decade. Naturally, no pun intended though, it's no surprise that they overtook Korea in 2019 by 3.1%. Nevertheless, there are plans to expand 7 of the 18 LNG import terminals and construct 11 new such terminals during the 2018 World Gas Conference by Li Yalan, chairperson of the board of directors for the Beijing Gas Group Corporation. For example, further plans to integrate the pipeline system in Bohai Bay area. The central government aims to construct new LNG import terminals in the same area to enhance supply security for the important Beijing, Tianjin, Hebei region. This will enable greater import volumes of natural gas for consumption with these supporting infrastructures that could also improve connectivity for LNG carriers for intercities or even internationally as these carriers proceed to make stops in China before importing to countries like South Korea and Japan. Speaking of Japan, they are still the top importers of LNG for decades with a whopping 25.4% of the total imports of LNG in 2019. With China looking to potentially dethrone them in 2023 as supply rises from 61 million tonnes in 2019 to 109 million tonnes in 2025, according to Sideline China information. Not forgetting that the diversity of supply is also another key priority in obtaining a constant supply of natural gas. Negotiating contracts between China and a wide range of countries such that a variety of import locations and transport operations are always kept available to provide natural gas to China. Over the past decade, Turkmenistan, Uzbekistan, and Kazakhstan have emerged as major natural gas importers to China. However, during the first 2 months of the year, Turkmen's imports have fallen approximately 17.2%, where natural gas took up 90% of exports in 2019, while Uzbekistan's exports to China, of which gas is a major component, declined by 35.4%. To make things worse, the decline continued for both countries for approximately 20 and 30% respectively. On the other side of the world, China resumed US LNG imports in April under Phase 1 deal of the U.S.-China saga, where an agreement was reached to increase imports of US energy products by $52 billion over 2 years, which implies $2.1 billion of purchases every month from 2020. From April to June, 3, 7, and so far 2 full-size cargoes have been imported into the Middle Kingdom. Perhaps China is looking to increase the purchase of US LNG as a bargaining chip to renegotiate its contracts with long-term suppliers including Turkmenistan and Uzbekistan, while trying to increase its sphere of influence in Central Asia against its rival Moscow. According to SCI, a provider of commodity information and analysts based in Shandong province, senior analyst Michael Ma commented, "Fearing a supply shortage like the one in 2017-2018 winter, China has implemented an ambitious expansion of import terminals. In our opinion, we believe that is the easier problem to solve as diversification of imports of LNG into China will keep on increasing and also in volume with the capital investments of ports and storage facilities that are either under construction or with solid plans to set in motion. No doubt, China has also tried to increase their pipeline gas imports with a new Power of Siberia pipeline, which will depend very much on the strength of the strategic partnership between President Xi and Vladimir Putin to continue the bilateral trade and agreements even after this pandemic. Just take a look at the projected increase in imports. However, China might have to go through multiple discussions and process of fine-tuning their policies to achieve some of the government's other objectives, such as increasing unconventional output of domestic natural gas in major basins such as Sichuan, where lofty production targets have often been set and gone unmet due to many issues left unaddressed. Pricing and reform sector, if you were to recall, the subsidies for production of domestic natural gas, plans for market-based pricing framework, and forming COGNPC, together with abolishment of a collaboration with any national oil companies for upstream exploration for domestic natural gas, are all certainly on the agenda for the National People's Assembly. But they are likely to be challenging to achieve and to take longer than the government anticipates, while domestic problems such as the response to the outbreak of coronavirus, plus the social and economic instability in Hong Kong, and what their next move might be. Next year's assembly might be the key indicator of the future direction of natural gas development in China as the economy hopefully recovers and the pandemic slowly subsides. Nevertheless, we can only speculate and watch as the saga between US and China unfolds right now. All in all, to bring back the concept of MLPs, it's a rather unappreciated investment form by many because of its complex tax calculations and because it's relatively new since the first MLP was formed in 1981. Generally, MLPs are attractive for income investors due to their historically high yields. But with the uncertainty that continues to plague the industry with plunging commodity prices and the potential for prolonged recession from the coronavirus as well, investors definitely have to exercise caution in picking the right MLPs based on one's appetite for risk. Besides the fact that the price of West Texas Intermediate crude oil for the month of May plunged more than 190% into negative territory in April, hitting its lowest levels in history and highlighting the plummeting demand for the commodity around the world, it illustrates how volatile a commodity like oil could be potentially worthless and subtly hints to the investing world that history could repeat itself again should all the stars align. While short-term fluctuations in natural gas liquids, natural gas, and crude oil prices might not have much effect, they can affect earnings on the unhedged portion of production or volume processed. However, in the long term, if there is continued downfall in energy prices, it can definitely affect drilling activity, which in turn may have an effect on pipeline MLPs, as they will have a lower volume of natural resources to transport. There's at least some speculation that a lot of MLPs will reduce or withhold distributions, at least until the global panic subsides. Besides, the world will also have to turn and look at China, a fresh competitor as it silently accumulates commodities such as gold, mentioned in the previous series, and now a growing interest in natural gas. Any radical move between the agreements made with the US could potentially have a detrimental impact to MLPs and definitely the entire outlook of natural gas as a strong commodity play as well. That said, MLPs could be a good place to find long-term buying opportunities. As the famous Baron Rothschild said, the time to buy is when there is blood on the streets. Contrarian investors may find one swimming against the currents of market, but figuring out which distressed stock to buy and selling them once the company recovers may very well be one of the important strategies to incorporate into one's investing plays. As such, it's important to justify to yourself what has driven the stock up or down and whether the drop in price is backed by fundamental analysis before filling up that buy order. And that's it for today's video. I hope that you have learned much from this 3-part series of exploring natural gas. Again, I'll be flattered if you have one key takeaway from this video which you can share with your other friends. Leave any questions you have in the comments and I'll try my best to answer all of them thoroughly. Stay tuned for the next video and invest safe.